Hey everybody! All right, it's Sunday night, and I'm going to give you another weekly update on what's going on with the S&P 500 earnings. All right, overall, what's going on, and then just kind of cover the top 100 companies in the index that reported earnings last week, and which ones are reporting this coming week. All right, it's going to be a much shorter one than the last couple because we're winding down now on earnings season. Going to be a lot less activity over the coming weeks. So this will give you a really good idea what's going on, though. And as usual, I'm going to break this down. So the very first part of the video footage covers more of the stuff that is of broader interest to TSP members. And then after that, it'll move on to the more specific companies, the top 100s, and what their earnings data, what impression their earnings data tells me about how good a buy or sell or hold they are. Okay, so if that any of that sounds interesting at all to you, then keep watching. Especially now for the TSP exclusive people. Reminder: C Fund follows the S&P 500, which is what I'm covering here. It'll give you an idea what to expect from the index and expect from C Fund as well over the coming quarters. And this is why I post this information for you. Okay, so keep watching. All right, so we're going to start with the slide here that makes that is of more interest to the broader population of the groups here. Uh, let's start with the current value where I have it set at right now. It's I have it currently set at 42.90. The index closed on Friday, I think, in the 44.30 something range, 44.20, 44.30, something like that range. I forget the exact number. But anyway, just a reminder: the current value or CV is what the earnings are currently saying is the index is worth right now, with no forward estimates added in. Now, just trailing earnings only for those of you guys who know anything about that kind of stuff. And then the expected one value, CV, 1, 2, 3, and 4 quarters ahead is also what I call the future value, or adding in the future estimate or the forward estimates for each quarter. That's what it's projecting the current value to change to. So right now it's at 42.90, and it's expected to rise to 45.25 over the next 3 months or next quarter. And then it'll rise to 46.90, and then 47.85 and 48.10. It's a consistent uphill climb, which is good to see. We want to see that, but it is slowing down here. As you see here, I got about a 230 or so point climb expected in the next quarter. That'll be rapid. And after that, it'll drop down about 170 or so point climb from the 1 to 2 quarters out, and drop to less than 100 point rate growth from 2 to 3 quarters out, and then only 30, or actually about 25 point climb from 3 to 4 quarters out. So going to slow down quite a bit there over the coming year, and I do expect to see the stock index funds themselves also probably slow their growth rates down some. And we'll cover a little bit more on that with stocks versus bonds when we get down to the bottom of this. All right, so right now the 12-month price estimate is kind of projecting the 50-70 level a year from now. Basically, where I think the S&P 500 is tentatively going to get to a year from now, based on the current growth trajectory, which we'll talk about down at the bottom of this same slide. Okay. Right now, the ideal trading range for those of you guys who are in the swing trade group is 43.90 to 45.50. As I mentioned, the index closed at 44.35 or whatever it was on Friday. So we're inside that range and kind of on the bottom end. I did have to make some adjustments to my calculations here. It's always a work in progress. There's always new things happening, and then a lot of times when constituent changes occur or when stock splits occur, it kind of screws up the way my formulas work at times. So, and I sometimes have to make adjustments and then figure out what kind of adjustment to make to make it jive more properly with what the market seems to be pricing in or willing to pay for. Okay, so we are, like I said, it's still on the bottom end of the trading range. There is, in my opinion, should be able to get it up to about 45.50ish or so, or in the low 4,500 range before expecting to see a short-term top. For those of you guys who are long-term buy and hold types, who follow Deb or have your own buy and hold strategy, don't worry so much about this ideal trading range. That's more for the people who want to trade a little more actively and have an idea, want to get an idea on where they might want to expect prices to top or bottom, or where top or bottom points might be. Now, most people do follow what's called technical indicators, but I'm not going to cover that. Yes, I do know all about a whole bunch about technical analysis, but I'm not going to cover it. It's not my particular area of interest, and we do have other people in the swing traders group who actually do cover a lot of technical analysis anyway. So, I'm not going to really cover that here. All right, so last week, I was expecting the companies that did report earnings last week to report to increase my current value or CV by 91 points. What they really did was plus 135 points. So the companies that reported earnings last week basically outperformed with the expectation, and that's always a good thing to see. Because if we're projecting, if it keeps performing like that, because we're already projecting growth over the next 4 quarters, if they continue to outperform what is already expected here, these numbers are going to be even higher than what you're seeing. So that'd be the ideal situation. I can't say it'll really happen, but like I say, it's always a possibility it could, though. And thinking idealistically, I guess, or optimistically, these numbers could go higher than what you're actually seeing here. All right, so next we're looking at how much of the S&P 500 has reported earnings already this quarter. This is this quarter being from July 1st through September 30. So any company that's reported earnings on or after July 1st, but before October 1st, will count for this. 433 of the companies have already reported updates. That's 85.7% of the index. As a reminder, there are 500 companies, but there are 505 stock symbols. So it's really 433 out of 505 is what that accounts for. So if you're trying to do some of the math on this, you might find that 433 out of 500 is not exactly 85.7%. All right, so I'll get that out of the way there. All right, change the current value so far this quarter is plus 472 points. That is a large jump. And the percentage of the companies that have already reported earnings so far this quarter and that have also reported growth over the same quarter last year is 87.8%. That is a very large amount. Very strongly positive. Don't expect it to stay that way, but we'll take that kind of number anytime we can, whenever they'll give it to us like that. Okay, now let's move on to earnings coming up over the next 4 weeks. This coming week, got of 9 through 13 August, got only 18 companies reporting updates, and I'm only expecting them to have a plus 8 effect on my CV. Okay, next week, 16 through 20 August, only expecting 17 companies to report, and they're also expecting a plus 8 effect on CV. And 23 through 27 August, it's going to taper down a little bit to 14 companies that week. And those 14 are only expecting a plus 2 effect on CV. Not much at all. Basically, all those companies are mostly all flat in terms of expected performance. And then end of August and into the first week of September, 30 August through 3 September, have only 7 companies tentatively slated to report that week. And they were expecting a plus 3 effect on CV. So overall, over the next 4 weeks, only expecting to change the CV number to change by about 21 points over between now and next month. Okay, so before I move on to the last part of that slide, I do want to point out that now with the earnings season slowing down, and you see how much slower it's going to be with not just quantity of companies reporting the rest of this quarter, but between now and the end of September, but also how much effect that I'm expecting their reports to have on my current value estimate. All right, so when that does slow down, I do normally expect the price behavior to, the gains in price to slow down as well, and might also start focusing more on the technical analysis driven indicators as well as the news. So, in other words, now that the earnings have come and gone for the most part, like I say, you got a substantial part of the index already reported now. Investors that are based on their movements on the earnings data are kind of moving out of the spotlight now. They're done making their moves for the most part, I guess. Might still be some activity there, but the volume of it, as far as the fundamentals based traders, is going to shrink. So what that's going to do is put the technical traders, the very common run of the mill retail investors, swing traders, whatever, um, them and the methods they use, the technical analysis, looking at charts and all that, are going to probably be more on the spotlight now. Also, news-related stuff that can also play a role as well, and those will be catalysts to getting prices to move in either direction. But overall, I wouldn't really expect too much movement from here on out until maybe before we get into October. So generally, about just before the start of the quarter, within a couple of weeks or so, the prices will tend to start moving in one direction or another in anticipation of what the earnings reports for the following quarter are going to start showing. So that's when I would start to expect something. So later September, I guess the second half of September is when I would expect to see some more, maybe some price activity in one direction or another. More likely up, but you never know. I'm not expecting a huge jump though, so I'll just give it that much. Okay, now let's go ahead and close out this particular slide and move on to the next ones with stocks versus bonds. I added these in because this is important information for you guys to keep an eye on. Right now, the expected stock earnings yield, or basically the S&P 500's earnings yield over the next 4 quarters, is slowing down to plus 12.12%. Okay, and it was up about 20% or so at the start of the quarter, but it is slowing down, and that's to be expected. Still, 12% growth over the next year is nothing to complain about. Usually only expect about 7 to 8% from the index on an average year, maybe 10% at most. So we're still looking at above average returns over the next year, but don't be surprised if it slows down some. Doesn't mean that we're going to start falling off a cliff, an economic cliff, but it does mean that we'll probably slow down to a little bit more reasonable numbers. Maybe you might see some more double-digit gains in the coming quarters or whatever, or coming years. We'll see though. All right, so expected bond yields. This is based on the 10-year Treasury note. Now, the 10-year yield did drop down to a short-term low. I think it was 1.18% on Wednesday, if I remember correctly, or somewhere in that ballpark. And when you do see bond yields drop, it's also an indication that investors are buying into bonds or increasing their prices. But Thursday and Friday, the bond yields went back up, and I think stock earnings also had an impact on that. Also, as I think the jobless and employment data that came out at the end of the week also had an effect on that. So with bond yields starting to climb back up, it means that there's a better chance there's going to be a shift, at least to some extent, from bonds back into stocks. But again, what drives bond prices in one direction or another doesn't necessarily translate to stocks going the opposite direction. It just depends on who's involved in that. What the volume is, who's involved. Where's their money coming from? Where's it going to? It's not always going straight back into other, like from stocks to bonds or from bonds to stocks. So there is some there are some differences or some nuances to that. But Generally speaking, though, when bond yields start to rise, you can usually expect stock prices to rise as well. That's how they tend to work. They don't have 100% correlation, but generally speaking, more often than not, if you see bond yields going up, expect to see stock yields rise, stock prices rise as well. Okay, also, recommended stock versus bond mix. Right now, I have it at 90% stocks and 10% bonds. Last week, I had it at 95% stocks and 5% bonds. But a combination of, or more so, the stock earnings yield slowing down to plus 12 from where it was. Started the quarter, like I said, around plus 20 or so, and it has slowed down gradually each week. Went down into the 19s and into 17s, and I think last week was maybe 15 or something like that, and then now we're down to about 12%. So overall, now, like I said, when stock earnings yields start to come down, then the recommended stock bond mix is going to shift a little more gradually toward bonds. So those of you guys who are a little bit more risk averse and maybe are a little bit are too concerned about having 100% of your money in stock funds and following Deb's and advice in the main group, I recommend you consider at least the stock and bond mix, the diversified distribution recommendation that you can find in the hashtag main announcement post in the main group. I do have information in there, and you can always follow it. And as the conditions change, or earnings yields slow down even more, or bond yields go up, which is what we typically do see when a recession does come. Because normally what you'll see is stock earnings yields will come down into low single-digit territory, and then bond yields will usually get up in like the 5 or 6% range or somewhere in that ballpark, and that basically suggests that bonds are just a better investment than stocks. So you can get more out of your invested money by being in bonds at that point in time than at stocks. And that's usually where the shift, or the paradigm actually starts for, or the snowball that starts working its way from bull market to bear market. Not always the case, but it's generally that's what we want to watch for as the most simple way to watch for problems ahead economically. Okay. All right, so I'm going to go ahead and move on now. For those of you guys who are exclusively TSP and don't really care about individual companies, at this point in time, you're welcome to stop watching and move on. And thank you for taking the time to watch up to this point. If you have an interest, if you have an IRA account anywhere or invest in individual stocks, whatever, maybe you do options or something, the rest of the info that follows might be of interest to you. Okay, so with that in mind, let's move on here. All right, so we're going to kind of talk about the top 100 companies that reported earnings this last week. There weren't a hell of a lot of them. I was expecting about 8 of them to report, which is not too many. Definitely a nice change from last week. I'm going to just cover real quickly with Eli Lilly first, and then you can use the same information I mentioned here with Eli Lilly to translate the rest of these stocks that you see here, okay? So Eli Lilly, or stock symbols LLY, they're a $252 billion market cap company. They were the largest of the companies that reported last week. So they reported earnings per share of $1.87. This is for the quarter. And the same quarter last year was $1.89. So they were actually down just a tad from last year. You always want to compare their quarterly performance to the same quarter the previous year, or as we call it, year-over-year earnings, okay? Because companies tend to be cyclical in nature, so from one quarter to the other, they might be busy or slow. H&R Block, or HRB, that's one I always recommend people look at for a good example of this. They're in the negative 3 quarters of the year, and then the second quarter, when tax season's around, they're always very strongly in the positive, and they're overall for the entire 12 months is usually positive as well. But yeah, and so you can't really compare one quarter to the adjacent quarter, or it's not a good practice to do, I should say. All right, so right now Eli Lilly's trailing 12-month earnings is at 803 per share. Also, as a reminder, the higher the earnings per share is, you see here, the higher the share price you can expect that company to have. Doesn't mean that the higher share price or higher earnings per share doesn't mean that they're not as good a company to invest in as one with a lower share price or lower earnings per share. It's just more of the dilution of their earnings. They could still be a more rapidly growing company with a high share price than another company with a low share price. Some companies dilute their earnings by doing stock splits or something, as you might have seen Apple do not too long ago, or Apple and Tesla. All right, so anyway, let's move on though. Just keeping this quick. Looking at the next 4 quarters ahead for Eli Lilly, expecting that 803 to climb to 844 next quarter, then it's going to drop back down to 789, and then back up to 8, and then up to 819. Overall, it's looking up, but they're kind of all over the place. They're up and down, so I don't. That's one I don't really think I would trust at the moment. I don't think that's worth selling. If any of you have them in your portfolio, or probably worth holding, maybe a slight buy. That's what a 3.5 would be to me. A 3 would be hold. 3.5 would be hold this the weak buy. 4 would be a buy, and then 5 would be a strong buy, and then 2 would be a weak sell, and then 1 would be a strong sell. All right, so that out of the way, now you can work with this information to go more quickly through the slide. If you want to skip ahead, you're welcome to. All right, so Moderna is the next largest company that reported last week. They are a $166 billion company. They were underwater the same quarter last year, but they had a very strong outing last quarter and looking very. The trailing 12-month earnings is very kind of double over that just in one quarter. So to me, they're a very strong buy. It's just straight upward right there. Very good one to buy shares in right now. Okay, Amgen. I'm going to go quick and to the point on this one. They're going to be a hold a week buy. Looking at more specifically, they were slightly up on reported earnings year over year, but they are expected to drop a little bit in earnings next quarter, and they are expected to rise over the next 3 quarters, but in terms of percent performance, it's just not enough. I do like to see upward, but if it's going to be low single-digit percent gains, increases in earnings, then it's you can expect the same in terms of share price as well, more than likely. I don't know if they pay a dividend. I did not look that information up, but if they are a dividend-paying company and your personal strategy favors dividend stocks, hey, that might be worth buying shares in. But if you're looking for growth or price performance, I would not be buying this company. I'd hold on to them, but not necessarily, not really do much else with them. All right, CVS Health. They are actually a little bit down on earnings from last year, not by a large amount, but they're down. They're mainly, I basically have them as a hold the week buy as well. Like I said, there's growth there coming, but it's just not strong enough to really be worth it. Why invest your money? Why put your money that's available and invest into companies like these that are not expected to do a lot right now? When there are other companies like Moderna that are expecting very strong earnings gains, and with that, probably going to see more share price performance as well. All right, moving on, we got Zoetis. I have them as a buy. They had a nice increase in earnings per share this quarter, and they are expected to go up. Not really a strong one, though. They're just barely enough, I would say, to where I made them a buy. They're only expecting, I think, between 5 and 6% earnings growth over the next year, and that's not really enough to interest me personally. And but they are at least better than the previously mentioned stocks that were on the last slide. So I'll give them that much. But generally speaking, if I don't see double-digit percent growth expected from the company, I don't give them a 5 rating. All right, now Booking Holdings. This will be the last one that actually reported last week. Actually, they were very strongly underwater this same quarter last year, but And they're still underwater this most recently reported quarter, but it's a very strong improvement. And the trailing 12-month earnings is actually positive in spite of what you see there for the quarter. And it's expected to jump quite a bit over the next 4 quarters. That's very strong growth. Also means you can probably expect more share price performance out of them. I do encourage you guys to comment on these posts also if you can, if you're, because I don't look at the micros with these companies, and I don't look on like each specific company's share price behavior. If you have an interest in maybe giving some extra analysis on these specific companies, or maybe you own shares of them or something, or you're interested in, let me know what you're seeing with the share price performance in hindsight later, or not just then, but even ahead of time, what they've been doing, and then looking in the quarters ahead at some point in time. Let me know, hey, did their price performance do exactly or something different from what my impressions here, or at least the earnings per share based impressions, are giving. All right, so moving on though. Okay, another company I had expected to cover this week was Fidelity National Information Services, or FIS. But they were right there on the edge of the top 100, number 99 or 100, somewhere in that ballpark. And between their share price performance and other companies coming in, they dropped out of the top 100. So I won't be talking about them this time around instead. Can't remember. I did look at the company that the companies that were at the bottom end of the top 100, but I don't remember if one of those. If any particular one of those companies was the one that bumped Fidelity out. All right. Also, Berkshire Hathaway, they always report their earnings on Saturdays. Last week I did say that they were tentatively scheduled for Friday, but I had a very strong suspicion they were going to report Saturday, and they did report Saturday because that's what they always do. Now, unfortunately, my source information, which I get through Ameritrade, does not have the updated data on their earnings tab yet. I could have manually done their analysis there with their earnings, but I elected not to. So I'm not going to have a good impression that I can give you on them in particular. But they would have been the largest company in the index that reported last week if I had done some information on them. Okay, so breaking those companies down into ratings, again, the 5 would be a strong buy. Those are Moderna and Booking Holding. And then a weak buy, I would say a weaker buy would be Zoetis, ZTS. And then hold the weak buys are Eli Lilly, Amgen, and CVS Health. I did not have any holds or sells that were in the top 100 this last week, thankfully, so these are all looking positive. Remember, I did have some holds and sells last week, including, I think, Amazon and Alphabet. And also, that reminds me, keep in mind that sometimes they can, if they have very strong beats on their expected earnings and the analysts haven't had a chance to adjust their forward estimates in any direction, or whatever direction they're going to adjust them before I get to their to the quarterly data, they might give some different indications on here than what might really be the case. So I'll offer that as a caveat for you guys, okay? All right, so this coming week, there's only one top 100 company expected to report, and that'll be Walt Disney. That'll be on Thursday, DIS. And that's it. Very slow week. Also, just for those of you guys who do care about it, I don't personally, but some of you guys do. Dow Jones Industrial Average. Walt Disney is one of the DJIA stocks. We don't cover the DJIA here in the group because they don't have any relevance to us. All the DJIA stocks are in the S&P 500 anyway. And the C fund follows S&P 500. S fund does not follow DJIA. Okay, a lot of you guys mistakenly believe that it is not. Okay, so just because S fund follows an index called Dow Jones U.S. Total Completion Index, a lot of you guys will see that Dow Jones part in there and automatically think it's the Dow Jones Industrial Average. Not even remotely the same. Sometimes like to say that what you're doing is comparing a Honda Ridgeline to a Honda Civic or something. The only thing that they have in common is that the same company makes it, and that's it. They're otherwise two completely different things. So don't mix that. Don't get the two confused just because you see Dow Jones. Dow Jones is just nothing but a company name, all right? Don't assume that every time you see an index with Dow Jones' name in it, it automatically means it's Dow Jones Industrial Average. They have a whole bunch of stock indexes. You just don't know what most of them are. All right, so that's all I have. Unfortunately, I can't really cover the S Fund too much because there are over 3,000 stocks in that particular index. That's another hint for those of you guys who mistakenly think Dow Jones Industrial Average is S Fund. No, it's not. S Fund follows an index with 3,000 plus stocks in it, and they cover all of the stocks excluding the S&P 500. Or basically, not all of them, but the broader U.S. market, of any market cap size, but it specifically excludes the S&P 500 stocks. Okay, that's all I have. And they don't have as much analyst coverage on their constituents. I have tried to follow the S&P 400 and S&P 600. Those are mid-cap and small-cap indexes in the past, but yeah, it's not so easy because too many of the companies in those indexes just don't have enough analyst coverage to really have earnings data to work with for my data collection process. And if there's too many of them that I have to go through other hoops to get data for or whatever, then or they don't have analysts at all, or just don't have enough analysts or something, then it becomes more unpredictable information and unreliable, I should say. So for that reason, it's better to follow just follow the S&P 500. It has a lot more analyst coverage. Not very many companies in that index at all don't have sufficient coverage to have earnings data to look at in a more easy manner. And the CNS funds tend to have good long-term correlation from day to day. So, right now I know C funds outperforming S quite a bit, and I'm not really happy about that, considering I'm in the S fund myself. But long term they do tend to play a leapfrog game. So just patience. If you're in the wrong one of those funds, just be patient. When the one that you're in starts to outperform the other, it might be the time to start moving back over to the other one. Okay. Or if you want to play a contrarian game like I tend to. Deb is more of a momentum type of strategy, I guess I would call it, where she focuses on the fund that is already performing stronger and will continue its momentum, and then only after it's already shifted to the other side is when she's more of a follow the trend instead of try to predict the trend before it predict the reversal before it happens. That's kind of how what the differences are ultimately between her strategy and mine. I'm not saying anything that's can't say that one strategy is better than the other. It's just which one is more ideal for your personality, your lifestyle need, whatever, the way you want to invest. You can do either one of them effectively. It's just pick whichever one interests you more. A lot about stock market is counterintuitive, so a lot of what you know is completely the opposite of what you might believe is the case. So keep that in mind too. All right, so again, you can get very effective. You can effectively use either one of these strategies that I talked about: Deb's momentum strategy or my contrarian swing trade type strategy. So, if you guys have any questions or comments, don't hesitate. Add them in the comments section. All right. We'll see you guys next week. Appreciate taking the time to watch. Thanks.